Hi there, my name's Ryan Satnik. I'm a mortgage agent with your home team, part of Dominion Lending Centers Alliance. What I'd like to talk to you about right now are some of the different terms that you're going to hear when you're shopping for your mortgage, and some of the different things that very often bank representatives and mortgage agents just kind of take for granted that we just assume that you know, and you may not necessarily, because how often do you shop for a mortgage? Some basic things, term being the life of your interest rate. So if you have a 5-year term or a 2-year term, that's the life of the interest rate. That's how long your interest rate is guaranteed for. Or in terms of a variable, how long you have a certain discount for. Then you also have your amortization. That is the life of your mortgage. So you'd hear things like, for example, a 5-year term with a 20-year amortization. So that's a 5-year lifespan for your interest rate, and then a 20-year lifespan for your mortgage itself. So obviously you'd have to renegotiate after the 5 years. Two different products that we do hear a lot about in the industry are fixed versus variable interest rates. The difference between the two is that a fixed interest rate is guaranteed for a certain period of time. So if you have a 5-year fixed interest rate, you're guaranteed a certain interest rate for 5 years. Variable interest rates are a little bit different than fixed, because with a variable interest rate, it is variable, so it will change from time to time. Currently, in our current economic climate, they haven't changed in quite a while, but the Bank of Canada has assured us that they will start to change eventually once the economy starts to get a little bit stronger. And what happens when that does take place is that you'll literally hear in the news that the Bank of Canada Governor, Mr. Mark Carney, has said that interest rates are going to rise by 0.5%. So if you have a variable interest rate, your interest rate on your mortgage will then raise by 0.5%. So that's something you need to be comfortable with. You need to be able to budget for that, and because there is naturally a little bit more inherent risk in the variable. Yes, the rate is lower, but you do have to know that there is the risk that it could eventually go higher. My name is Ryan Satnik. I'm a mortgage agent with your home team. If you're looking for a mortgage, I'd love to speak to you.